China's economy is sending shockwaves across the globe, and the epicenter lies in its troubled real estate sector. The warning tremors began in 2021 with the Evergrande crisis, exposing the fragility of a sector fueled by excessive borrowing and speculation. Now, as we navigate through 2024, the situation has escalated, drawing stark parallels to the country's 2015 stock market crash and the subsequent economic slowdown. In 2015, China's stock market experienced a dramatic boom and bust cycle. Fueled by easy credit and speculative investments, the Shanghai Composite Index surged by over 150% in just 1 year. This rapid ascent, however, proved unsustainable. Fears of a bubble led to a sharp correction, wiping out trillions of dollars in market value and triggering panic among investors. Fast forward to 2021, and a similar story unfolded, this time centered on the real estate market. Years of unchecked growth in property prices and a surge in construction activity culminated in a mountain of debt, particularly for property developers like Evergrande. When the government intervened to curb risky lending practices, the bubble burst. Defaults, stalled projects, and plummeting property values became the new norm, shaking investor confidence and sending ripples through the Chinese economy. The parallels between 2015 and the current crisis are undeniable. Both episodes highlight the risks of China's debt-driven growth model, its vulnerability to asset bubbles, and the challenges of managing a rapidly evolving economy. However, the current real estate crisis is unfolding against a backdrop of new and significant challenges, most notably China's shrinking population. The decline in population growth, a consequence of decades of the one-child policy, is now a stark reality with far-reaching consequences. A shrinking pool of homebuyers, coupled with a legacy of overbuilt properties, is exacerbating the real estate slump. This demographic shift adds a new layer of complexity to China's economic woes, demanding innovative solutions and a recalibration of growth expectations for the years to come. China's population has begun to shrink, a demographic shift with profound implications for the world's second-largest economy. After decades of robust growth, the country's population peaked in 2022, marking a turning point in its demographic trajectory. This decline, driven by a combination of factors including falling birth rates and an aging population, is poised to reshape China's economic landscape, particularly its once booming real estate market. The impact of a shrinking population on the real estate sector is multifaceted. With fewer young people entering the housing market, demand for new homes is dwindling. This decline in demand is particularly acute in smaller cities and less prosperous regions, where overbuilding during the boom years has resulted in a glut of unsold properties. The once reliable engine of economic growth, fueled by rising property prices and construction activity, is now sputtering. Adding to the woes of the real estate market is the changing structure of China's population. As the population ages, the demand for larger family homes declines, while the need for smaller apartments and retirement communities rises. This mismatch between existing housing stock and evolving needs further dampens the prospects for a quick recovery in the real estate sector. The implications of population decline extend far beyond the real estate market. A shrinking workforce translates to slower economic growth, reduced consumer spending, and a strain on social security and healthcare systems. China's government faces the daunting task of rebalancing its economy, transitioning from an investment-driven model to one that relies more on innovation, productivity growth, and domestic consumption. In the face of these economic challenges, the Chinese government's policy responses have been closely scrutinized, both domestically and internationally. In 2015, as the stock market bubble burst, the government intervened aggressively, deploying a range of measures to stabilize the markets and prevent a wider economic meltdown. These included injecting liquidity into the financial system, easing monetary policy, and restricting short selling to curb panic selling. The government's intervention in 2015 had mixed results. While the immediate crisis was averted and the stock market eventually recovered, the heavy-handed approach raised concerns about market interference and the sustainability of China's economic model. Critics argued that the intervention delayed necessary market corrections and reinforced moral hazard, encouraging excessive risk-taking in the future. Fast forward to the current real estate crisis, and the government's response has been more measured, reflecting a greater awareness of the risks of excessive intervention. Instead of rushing to prop up failing developers, the focus has shifted towards containing systemic risks, ensuring the completion of unfinished housing projects, and gradually deflating the property bubble. This more cautious approach, while prudent in the long run, has come at the cost of a sharper economic slowdown. The real estate sector, a major contributor to China's GDP, has contracted significantly, dragging down overall economic growth. The government's ability to engineer a soft landing for the economy, avoiding a hard crash while navigating these complex challenges, remains to be seen. As China grapples with its current economic woes, the question on everyone's mind is whether the country can successfully navigate the real estate storm and avoid a repeat of the 2015 stock market crash and its aftermath. The parallels between the two crises are striking, but so are the differences, offering both hope and caution in equal measure. One key difference lies in the nature of the crises themselves. The 2015 stock market crash was largely a result of speculative excess, with investors pouring money into the market based on hype and unrealistic expectations. The current real estate crisis, while also fueled by speculation, is rooted in more fundamental imbalances, namely, a shrinking population and a legacy of overbuilding. This difference in underlying causes suggests that simply replicating the 2015 playbook of aggressive market intervention is unlikely to be effective this time around. Addressing the current crisis requires tackling the root causes, which means accepting a period of slower economic growth, managing the risks associated with deflation, and implementing structural reforms to rebalance the economy. Another key difference lies in the global economic backdrop. In 2015, China's economy was still growing at a robust pace, providing a buffer against external shocks. Today, the global economy is facing its own set of challenges, including high inflation, rising interest rates, and geopolitical uncertainty. This less favorable external environment limits China's policy options and increases the risk of contagion, where economic problems in China spill over into the global economy.